Welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics like wealth creation strategies, investment principles, creating passive income, paying off your debt faster, and much, much more, so you can live a life on your terms without limits.
Hello and welcome back to another episode of the 360 Money Matters podcast. I'm Billy and I'm joined by my co-host,
Andrew. Bills, how are we?
Andrew. We are good.
We are good and back again.
In the recording studio.
Yes, absolutely. And what are we discussing today? What do we have packed for our viewers and our listeners today, Bills?
So Andrew, this is actually a question that we've got from a regular listener of the podcast,
Yep.
Alan. So thank you for submitting that to us. So we were just going to talk through what the question is and how we'd address it and some of the things that we'd think about in terms of combating, I guess, a challenge that he's having.
Yeah.
Basically what it is he's recognised the need to start investing, which is great, but there's some trepidation and there's some fear in doing so. So the question really is how do I move forward with that? I wouldn't say how do I get over that fear, but how do I move forward? Because I know that, I need to invest.
Yeah. Look,
How's that for a can of worms?
It's so common. I mean, to talk about this topic and, I mean, to ease your mind, Alan, and probably also to our listeners as well, this is something that whether people recognise it or whether it's just an unconscious bias is, that's yet to be known. But it is so common that, people recognise, hey, I need to do something with my money. But firstly, most people, express it in a way of, I don't know what to do. But I think that really there's an abundance of information that you can gather in order to arm yourself with information on what you can do. But what most people are saying, and what, discussions that we have with clients, what you eventually uncover when you sort of unpack that a little bit is, yeah, okay, I understand that there's, some things that I can do, but I'm fearful, and there's some trepidation in, taking the next step from a financial perspective and investing when maybe I haven't done so in the past.
Yeah, and it's one of those things that I want to call out, but that's, in our experience, that's quite a natural thing. Like, financial literacy in Australia is considerably quite low, and I feel like it shouldn't be like this. So we're not necessarily taught that in the education system. We don't naturally have exposure to these sorts of things. So it's a natural thing.
Yeah.
So, I just wanted to get that out there because you shouldn't feel bad about it.
Ashamed or
like you're lacking or inadequate or whatever it is. But recognising that there's a need and asking the question is definitely a good start. So I guess that's a really long conduit into the way that I'd be thinking about this from Alan's perspective is tick the box, that you need to do it, which is great. But from an education perspective, how do I get educated around some of the things in order to help alleviate some of that fear and trepidation that I'm experiencing?
Yeah, absolutely. And the fact that you're listening to the 360 Money Matters podcast is just arming yourself with all of the knowledge that...
No, you beat me to it. I was going to say exactly the same thing. I'd be starting with the first episode of the 360 Money Matters podcast, going back to episode number 1 and listening to that. And that will bring you up to speed and you'll be an industry expert. You could probably get a job with us here, right? So...
No, but look, and in all honesty, I think, knowledge is ultimately power. And you want to kind of, I mean, there's two trains of thoughts that I'm going to go on this. In that, firstly, knowledge is power. And so listening to podcasts, reading articles online, following business news, following economists, absolutely fantastic. More so just in the sense of knowing what's out there, understanding concepts, and really getting familiar with things. Sometimes, and pushing that too far, can mean that people, there's now an endless supply of options and you just don't know what direction to take because you've just got too much information in your head. So usually the approach that I would take is podcasts are great because you can listen to, one financial advisor on 360 Money Matters, or you can listen to, another financial advisor that just resonates with you more. It makes more sense to you. The concepts, just speak to you more than something else. So being able to really almost, obviously you're not receiving advice from that person, but listen to the concepts that one person has versus another person, and then you start to see some similarities between them and recognize, hey, this is probably the best approach. Sometimes people can just listen to too varying or too wide arrays of opinions, and all of a sudden it's like, I just don't know what to do.
Yeah, and I guess that's where the saying comes from. Too much or a little bit of information can be dangerous, right? So, agree with what you're saying, Andrew. And probably from my perspective, as part of that education piece, I think looking at just financial markets, and it could be as simple as understanding what the All Ords Index is, or the S&P 500 is, and then have a look at the performance of that over a period of time, and then overlay that with the compounding interest. Use a calculator, put those numbers in, run that number through a calculator, and you get to see, what we talk about in terms of investing, dollar cost averaging, which we'll talk on a little bit later with a small amount, and that growing over a long period of time. But you can replicate that theoretically using historical data and a compounding calculator, and saying, okay, if I achieve a certain rate of return and invest a certain amount of money, this is the outcome that I can expect down the track. Now, once again, past performance is not an indicator of future performance, but we use certain assumptions in order to make certain predictions, and that's how we make calculations around where we can grow a particular portfolio. So education, uplifting that little bit of knowledge from some sources that are trustworthy and that you resonate with is definitely a great start from Alan's perspective.
Yeah, absolutely. The next thing, or not maybe the next thing, but another thing to ultimately consider is, when you're investing, you really need to take into account your tolerance to risk, your comfort levels, what, not just makes sense to you, because you also want to, have exposure to, things that you may not have knowledge over. But once you do take that step, make sure that it passes the sleep test, as we like to say.
40 winks.
Make sure that, you're investing in some safe assets along with some volatile assets. Have some money in, term deposits or bonds. Have some money that's in, shares or property. Have some money that's really aligned with your tolerance to risk and your comfort levels. And I think for a lot of Australians and a lot of people, the big one is property. And so if you're comfortable with property and you see that as, hey, I can see my asset, I know exactly, I understand it more because I see that, supply and demand is going to dictate price, and there's going to be, someone that's renting that's going to have an income, and all of the financial metrics stack up, then go for it. I mean, it's not, you don't need to put everything into something that you don't understand. If you understand one asset class more than another asset class, then maybe that's your first step before you build on with, other things if you're taking your first step into investing as well.
Yeah, no, well said, Andrew. And just want to elaborate on that a little bit because, we talk about risk profile and asset class, and all of this sort of stuff is industry language. One of the things that I always like to talk to people about is, no matter what you do, and we'll talk about this in the concept of investing, no matter what you do, you're assuming risk.
Of course.
So even if you choose not to invest, you're still assuming risk. And that risk is that your money is going to get eroded by inflation. Your risk is an opportunity cost that you're not taking advantage of an opportunity in front of you to be able to grow your money and grow your wealth. So by doing nothing or by doing something, you're taking some level of risk. So when you enter into these things, you can't have your cake and eat it too. You can't say, I want to grow my money by X amount of percent and I don't want to take any risk. It's just part and parcel of the way that life works. So when we talk about risk, I also think it's important to say not doing anything is a risk within itself, and needing to be really clear about that and calling it out, because, we often get that because people maybe don't necessarily have the education piece behind them when they're making decisions around their finances. And sometimes it can get overwhelming, and it's kind of like, you just get paralyzed by all of these different choices or terminology or language, and it can get all overwhelming. And it's kind of like the deer in the headlights or the rabbit in the headlights type of scenario where nothing actually happens.
Yeah.
And there's risk associated with that as well. So I thought that was quite a relevant point to call out as well.
And I think, touching on, and this will vary depending on, what market cycle you're in and where things are at. But I think you made a really interesting point there in that by not investing, you're basically saying in the current environment that I am not going to put money into investments because I'm not comfortable with the risks associated with it. So I'm going to lose money, is basically what you're saying. Because your inflation rate is at, say 5%, just as an easy number. Your savings rate in your savings account might be at 3%. If you're, putting some money in some term deposits, some in some regular savings accounts. So you're basically saying, okay, I'm going to lose 2% of my money in order to not take any risk. And so recognizing that, hey, I need to do something so that I'm not actually losing money each year is also an important sort of first step to touch on sort of what you were saying as well.
Yep. So understanding that there's risk associated with any course of action that you take, and then one step further in terms of engaging a conversation with a professional is getting an understanding of your risk tolerance.
Yeah.
And there's some tools and things that we use in order to help assess that. Yeah. But understanding that what that is, and then you can invest, I guess, accordingly to that. But as an extension of that, there's also some probability built into that around what type of rates of return that you can expect from a particular risk profile. And it even goes one step further in terms of looking at the difference of return that you can expect over a period of time, and even to the extent where it goes to, in X amount of years, how many negative rates of return can you expect, assuming that particular risk profile as well too. So going through that exercise gives you a really deep understanding of what you can expect based on some of the historical data that we've seen.
Yeah, exactly. Another one, just don't follow any trends, don't follow hypes. I mean, there's been assets that have been around and done well for many years and many generations, and the likelihood that that's going to continue is significantly higher. I'm not looking at anything in particular, but I'm just going to preface it with, a trend and a hype has potential for, some returns that may do incredibly well, but it also subsequently has a significant amount of risk in that it may go to, zero, it may go to, so stick to your blue chip, stick to your stable assets, stick to things that, there is some historical information and valuation behind them as well.
Yeah, I mean, one of the things that we talk about, and, what Andrew was alluding to there was essentially gambling, right?
Yeah,
right?
Exactly right.
Gambling with, I won't even call them assets. I don't even know where to go with that, but gambling in terms of, I don't know, funny money, fake assets, non-existent assets, non-tangible assets, whatever it may be. But I think I've lost my train of thought with that one. I had it there and I went off on a tangent, Andrew. It's going to come back to me in a sec. So,
now look, essentially what we're trying to say is stick to your, especially when you're talking about first-time investing, especially when you're talking about building a base. I'm not saying that there are, that you never take a significantly large risk with any of your investments. But if you've got 95% of your assets in some good blue chip assets that will be around in 10, 15 years time, and you look at it and say, you know what, there might be 5% that it's a gamble. I might put it in there and it may go to zero, and that's fine. I'm comfortable with that. I'm recognizing that. But to put all of your money, when maybe you're young, and I'm just making an assumption here with Alan that, you may, since you haven't invested, you might, be young, putting all of your money in something that may not be around in 5-10 years' time means that not only do you lose, and I don't think that's actually the biggest impact. Let's say you lose everything when you're first starting out and it all goes to zero. That realistically is probably not going to impact your, long-term wealth creation all that much. But the impact that it will have is your fear of putting any dollar towards any investment, whether that's in 5 years' time or 10 years' time, is really going to, prohibit you from being able to do anything bigger and larger in the future.
Yeah, and look, that sort of reminds me about my point that I was talking about. When we think about investing, we're trying to get the greatest return for somebody for the least amount of risk.
Correct.
So when you think about investing and talking about potentially some stuff that we've seen recently with, crypto gains and things like that, those returns have been distorted, where you can put, $100 in and leave it for 10 years and it's worth millions. That distorts it. And, using your example before about investing in high risk things, not going to call them assets, you invest in high risk things. If they go to zero, it's gonna scar you from your investing journey and derail you, right? From my perspective, when you invest, it's not investing if your investment can go to zero, right? It's gambling.
Yeah.
So first and foremost, so if that's a concern and that's a reality, then you're in the wrong asset. So going back to what you said, if we take a prudent approach to investing, yes, you experience volatility, it should never go to zero.
Yeah, exactly.
And you don't need to find an investment that does, 30% each year in order to create wealth. You can do that with market rates of return across different asset classes that we've seen. And if you're prudent and you do it right and you do it for a long period of time, you're going to get to where you need to go for the vast majority of people without needing to gamble to try and hit it big.
Yeah. And I think that is the key. That last point that you just said there, invest for the long term. You're not trying to create wealth overnight. You're trying to create it over a number of years. And a really, very good visual representation of this is pick a share market. Pick any share market that you like. I'm talking about big countries or established economies, whether you choose the US, so whether you look at S&P, whether you choose the ASX, look at, Australia, and look at the volatility that's associated with it within a month. And you're going to look at it and you're probably going to have some fear and trepidation around investing. Zoom out and look at it over the last 10 years. And it looks so smooth. It looks like it's just the boat sailing off into the sunset, and it's just, or maybe, a cable cart going up a hill or a mountain, and it's just, really consistent. And you might see a couple of drops in, a GFC type event or, like COVID or anything like that, but then it just comes back up and it just goes smoothly. And so when you take a step back and say, hey, this isn't a short-term investment. I'm not trying to do it overnight. I'm doing it long-term, and I'm looking at what the returns are going to be, over a long-term or a 10, 15, 20-year time frame, pick your time frame, whatever it is. It should give you some comfort in that, okay, this is not as volatile when you take a long-term view.
Yeah, and look, you hit a few things on the head there. Obviously, long-term investing, right? Starting out, if you're a beginner, starting out small to get some comfort and to get some exposure to it, and invest regularly over a long period of time, which is basically dollar cost averaging. Yeah. So you're getting the moving average of whatever the market's doing, as opposed to needing to time it and pick the right points to purchase or to sell.
Yeah.
And you do that over time, you'll be able to see how things perform. You'll get an understanding and an expectation of what's possible. Naturally, you should become more comfortable with the process and with the journey. And as a result and the byproduct of that, your education with it will also go up as well too.
Yeah. Exactly.
And I think it's almost as simple as a couple of those things in order to get somebody comfortable, but recognizing the need to invest and grow your wealth, even if, and it doesn't need to be anything like capitalism or being greedy or anything like that. You need to do it in order to stay ahead of inflation. Otherwise, you're going to go backwards, even if you don't do anything.
Yeah. And I also think that the perfect example of a long-term viewpoint on an asset is super. Most people, you're talking about, at the moment, 11% of your income. That's a pretty significant amount of your income goes towards this asset. And the number of people that we ask what their superannuation balance is, and they have no idea. It could be 30, could be 50, could be 150, could be 20. I have no idea how much is in my superannuation fund. And I think that the reason behind that is it's such a long-term asset that no one's looking at the short-term volatility associated with it. You're going to assess it, and if you're prudent, you're going to look at, the right asset class, you're going to look at the right assets and the right fund and all of that stuff long-term. But most people aren't obsessed over the daily movements because it's such a long-term asset. Mm-hmm. If you take that view across all of your assets and all of your investment decisions, really should give you some comfort in knowing that, this is the short-term volatility isn't a concern.
Yeah. Another thing is, we're obviously big advocates of advice. So getting advice from a professional is definitely a step in the right direction for a range of different outcomes, a range of different reasons. It could just be something as a consultation with a financial advisor, or it could be, I understand this, but I want to leave it to the professionals and engage a financial advisor to put a recommendation together for you in terms of what it is that you want to achieve. But from my perspective, getting advice on that is the shortcut way of rather than needing to go through that whole process, because rather than going through that process yourself, because a financial advisor will take you through that and tick off all of those things and make sure that those things are addressed that you probably haven't even given consideration to.
Yeah, and looking at assets in your personal situation. I mean, there's been obviously a rise of finfluencers in the market at the moment, and I don't know, maybe we're in that category, maybe we're not, I don't know. But the
Andrew's on TikTok, by the way.
Yeah, exactly right. Maybe I should, throw my TikTok handle out there in case anyone wants some short snippets rather than our long form podcast. But being and understanding that, okay, a 2-minute video or even a 30-minute podcast is not going to assess your personal circumstances. It's going to arm you with some information and some knowledge. And hopefully you're receiving that from someone who is actually an accredited financial advisor. And so I think that's, when we talk about the knowledge part, that's also a key. But seeing a financial advisor, even if it's just for one consultation, is going to kind of put all of that, information, you talk about a funnel into, all right, this is relevant, this is not relevant, this is, for your circumstances, something that could be a potential option, this is just not an option because of XYZ reason, and personalize all of that information into a strategy for you. And that's ultimately what it is there isn't a one size fits all in anything because everyone's circumstances are completely different. And so putting that into something that is tailored and within your tolerance to risk and within your preferences and taking into account the broader market and everything really develops a strategy that's ultimately right for you. And so I really couldn't be a bigger advocate for that, whether it's, with us at 360 Financial or any other accredited financial advisor. I mean, the trust that I have in the profession is probably is exorbitant. And so being able to, talk that through with someone, I think is a really good, first, middle, or last step wherever you are in the journey.
Yep. Another tip, pay attention to your investments because you need to know where you're at. You need to know what your position is. And I think doing that is prudent. But if it becomes an obsession, unless you're in the industry, maybe a bit of a different story. Or if it's something that you're completely passionate about and you love doing it, that's probably the two examples that I'd use to say it's okay. But don't become obsessive over it because, the rabbit hole is quite deep and you can go off on so many different tangents from an investing perspective and what different markets do and how different things behave, and trying to find correlations between different things. And you can burn up a lot of time and energy, and it can take, a toll on on you if you do that. So I'd say pay attention to it, but don't become obsessive about it.
Yeah. And I think you've made the decision, you've started investing, and you also don't want to be oblivious, right?
Yeah.
Like there's the other end of the spectrum where you just put it in, leave it, and forget about it and continue to follow that same strategy, and it's, no longer appropriate. But not becoming obsessed, it's massive. The amount of times that I've seen people make irrational decisions because, the market's dropped, 1% in a month, and all of a sudden they really feel like the need to, make a change or do something. It ultimately doesn't lead to rational decision making. And so, again, take a step back, take a long-term view, understand, hey, is this something that, is actually, because there are going to be things that are going to have a significant long-term impact in the short term, and so you need to change direction, but not becoming obsessed with it is another, really key thing.
Yeah, really good fundamental. Yeah. And recognizing that it is for the long term. We often say that, and once again, we say that because we want the compounding effect to take effect, and plus it also rides out some volatility as well too. So if you're going to go into an investment, whatever it may be, it's got to be for the right time frame, and you've got to match your investment to the time frame that you perceive to, you anticipate to have that money invested for. So if it's a short-term investment, as an example, you've got a large pool of money that you're going to be using to purchase maybe a larger asset like a property, and that you're going to use that within the next year or so, we'd be saying, hey, maybe you don't expose it to markets, because if you get to 12 months down the track and markets are volatile and that amount has gone down, it's going to have a significant impact on what you flag that money for. So we'd say, consider something else. So knowing your time frame, but if it's for true wealth creation purposes, we do talk about investing for the long term.
Yeah, exactly right. Bills, I think that's covered it, Alan. I hope that's answered your question and armed you with some tools to be able to, take the next step in your investment journey. And again, if this is something that, you're struggling with, or, you'd like to talk about your situation, feel free to reach out to either Billy, myself, or anyone here at 360 Financial.
Like and subscribe. Thank you for your time, and we'll catch you on the next one.
Thank you.
Thanks for listening today. If you have any questions on what we talked about, or would like to have a chat about your money journey, visit us at 360fs.com.au.
Just a reminder to our listeners that the information contained in this podcast is general in nature, and it is not intended as personal recommendations for the audience. Please consider whether the information suits your circumstances before acting on it. This information is provided by Billy Amaritis and Andrew Nicolaou of 360 Financial Strategists Proprietary Limited, authorised representatives and credit representatives of AMP Financial Planning.